Two numbers, both sourced, both current to this week, both worth understanding. Number 1, 41.4. That is the current Shiller CAPE ratio, the cyclically adjusted price-to-earnings ratio for the S&P 500 as of July 2026. The CAPE was developed by Nobel laureate Robert Shiller and measures stock prices relative to the average of the past 10 years of inflation-adjusted earnings. The long-run median of this ratio, going back to 1881, is 16.1. The current reading of 41.4 is 77% above its long-term trend line and in the highest historical quintile, suggesting a highly overvalued market. Number 2, 237%. That is the Buffett Indicator, the ratio of total U.S. stock market capitalization to U.S. GDP as of July 16, 2026, according to Guru Focus. Historically, this ratio reached a record high of 237.9% and a record low of 32.7%, with a median value of 81.3%. The current reading is not just elevated. It is, by this measure, the highest it has ever been in recorded market history. These two numbers have generated significant debate. Are they warning signs of an imminent crash? Or are they artifacts of a changed economy, one where structural shifts in corporate profitability, globalization, and the AI investment wave have permanently altered what fair value looks like? This video answers that question with the actual data. The honest answer is more nuanced than either the bears or the bulls usually admit, and it has specific, actionable implications for Canadian investors right now. The Shiller CAPE ratio, explained. The standard price-to-earnings ratio divides the current stock price by the last 12 months of earnings. The problem with a standard trailing PE is that earnings are cyclical. During recessions, they collapse, making the PE look artificially high. During booms, earnings surge, making the PE look artificially low. Robert Shiller's solution was to smooth earnings over a full 10-year cycle, dividing current prices by the average of the last 10 years of inflation-adjusted earnings. This removes the boom-bust noise and provides a cleaner read of underlying valuation. As of June 2026, the Shiller CAPE ratio stood at 40.96. This level has been touched only one other time in market history, from late 1999 to early 2000. That was right before the tech bubble burst, which resulted in the S&P 500 falling by half and the NASDAQ 100 dropping by 80%. The current July 2026 reading of approximately 41.4 means investors are currently paying approximately 41.4 times a decade's worth of smoothed, inflation-adjusted earnings for S&P 500 exposure. The long-run median is 16.1, meaning the market has historically been priced at approximately 16 times this earnings measure. Research shows a strong inverse relationship between CAPE levels and subsequent 10-year returns. When CAPE is high, future returns tend to be low, and vice versa. This makes it one of the best tools for setting long-term return expectations. The Buffett Indicator, explained. Warren Buffett once described the ratio of total market capitalization to GDP as the best single measure of where valuations stand at any given moment. The logic: if the total value of all publicly listed companies is growing dramatically faster than the actual economy that generates their revenues and profits, the market may be pricing in expectations that the economy cannot realistically deliver. As of July 21, 2026, this ratio is 234.3%. The median value over the full recorded history is 81.3%. The current ratio is approximately 2.1 standard deviations above the historical trend line, suggesting that the U.S. stock market is strongly overvalued. The forward PE, a different read. The trailing PE uses the last 12 months of actual earnings. The forward PE uses next 12 months of analyst earnings estimates. The S&P 500 forward PE is approximately 21.5 as of July 2026. This is still above the historical average of approximately 15 to 17, but meaningfully below both the trailing PE of 32 and the CAPE of 41. The difference matters, and it is addressed in Segment 3. High valuations have a documented track record in historical data. Here is what actually happened after the two closest historical parallels to today's CAPE reading. The dot-com parallel, December 1999, CAPE 44.2. This level has been touched only one other time in market history, from late 1999 to early 2000. That was right before the tech bubble burst, which resulted in the S&P 500 falling by half and the NASDAQ 100 dropping by 80%. The CAPE reached its all-time high of 44.2 in December 1999, approximately 3 months before the S&P 500 peaked and began its decline. Between March 2000 and October 2002, the S&P 500 fell approximately 49%. The NASDAQ fell approximately 78%. Investors who were entirely invested in U.S. large-cap equities at peak CAPE of 44 endured a 2.5-year bear market that wiped out years of gains. The post-pandemic parallel, November 2021, CAPE approximately 38 to 40. After the pandemic-era monetary and fiscal stimulus drove an extraordinary bull market, the CAPE reached approximately 38 to 40 in late 2021. What followed, the S&P 500 fell approximately 25% from peak to trough in 2022, while growth and technology stocks fell significantly more. This was driven not by a recession, but specifically by the rapid interest rate hikes as the Fed fought inflation, compressing valuations from elevated levels. The long-run forward return data. The PE10 is currently in the highest quintile, suggesting a highly overvalued market. Historically, when the PE10 has fallen from the top quintile, it has often continued its decline into the lowest quintile. As of July 21, 2026, the stock market is likely to return -1% a year in the next 8 years based on TMC/GDP. This is a model projection, not a guarantee, but the historical relationship between current valuation and forward returns is one of the most robust findings in financial research. When the CAPE is this elevated, subsequent 10-year real returns have historically been low or negative. The critical caveat: timing is impossible. The CAPE has been elevated since the mid-1990s. An investor who sold all equities in 1996, when the CAPE reached 28, then well above historical average, missed one of the greatest bull markets in history, including 6 more years of gains before the dot-com peak. Valuations can stay elevated for years. A high CAPE is not a sell signal. It is a signal to lower your forward return expectations. The honest conclusion from the historical data: the current CAPE of 41.4 is consistent with lower than historical average forward 10-year returns. It does not tell us when a correction will happen or how large it will be. Investors who sold at CAPE 30, CAPE 35, and CAPE 38 have all been wrong about the timing, even if they are eventually proven right about the direction. Here is the vault. The specific structural arguments that suggest the headline "valuation numbers," while genuinely elevated, may overstate how overvalued the market actually is. These are not dismissals of the concern. They are genuine adjustments that any honest valuation analysis needs to account for. Bull Case Adjustment 1. The Globalization Correction on the Buffett Indicator. The classic Buffett Indicator divides U.S. total market cap by U.S. GDP. But as FactSet reports, more than 40% of S&P 500 companies' first-quarter revenue came from foreign economies that don't affect the United States GDP figure. In 1970, the S&P 500 earned approximately 20% of its revenue overseas. In 2026, it earns approximately 41% overseas. Dividing a globally generating company's market cap by U.S. GDP alone understates the denominator. The globalization-adjusted Buffett indicator is approximately 112%, still above the historical average, but meaningfully below the alarming 237% headline number. At 112%, the market is modestly overvalued by this adjusted measure, not in record bubble territory. Bull Case Adjustment 2. Structurally higher corporate profit margins. The CAPE uses historical earnings going back 10 years. U.S. corporate profit margins have structurally widened over the past 2 decades, driven by technology, globalization, asset-light business models, and network effects. If today's earnings power is structurally higher than the 10-year historical average implies, the CAPE will look elevated even at fair value. The question is whether today's margins are sustainable or represent a cyclical peak that will eventually mean revert. Bull Case Adjustment 3. The AI Productivity Wave. The current market includes companies at the leading edge of what may be a major productivity transformation. AI investment is cited across multiple 2026 analyses as a genuine tailwind supporting both current earnings growth and the market's willingness to pay elevated forward multiples. The S&P 500 is reasonably valued, in fact, at a forward-looking price-to-earnings ratio of 21.5. If AI-driven earnings growth is genuine and accelerating, the forward PE of 21.5, while above the historical average, may reflect a reasonable expectation of that growth, rather than irrational exuberance. Bull Case Adjustment 4. Interest rates are lower than historical averages. Valuation multiples expand when interest rates fall, because future earnings are discounted at a lower rate, making them worth more today. The past 2 decades of structurally low interest rates, with the exception of the 2022 to 2023 hiking cycle, have supported higher PE ratios than pre-2000 norms. If the structural rate environment remains lower than the pre-2000 average, a higher fair value CAPE than the historical median is arguably justified. The honest summary of the adjustments. The adjustments are real and should be taken seriously. They suggest that the appropriate CAPE, fair value in today's market, may be higher than the historical median of 16.1. But they do not explain a CAPE of 41.4. The globalization-adjusted Buffett indicator at 112% is modestly overvalued, not extremely overvalued. The forward PE at 21.5 is elevated but not extreme. The CAPE at 41.4, however, requires either sustained AI-driven earnings acceleration or ongoing investor willingness to pay record multiples. And history suggests both are fragile assumptions. This is the most important segment for any investor who has just heard the valuation data and is wondering what to do with it. What high valuations reliably predict? Lower forward returns over long horizons. This is the most robust finding in the valuation literature. When the CAPE is in the highest quintile, as it is now, subsequent 10-year returns have historically been lower than average. Not necessarily negative, but lower. The model projection of approximately negative 1% real annual return over 8 years from the current Buffett indicator level reflects this relationship. An investor deploying capital today should expect lower returns over the next decade than the historical average of 10%, probably somewhere in the range of 4% to 7% nominal annually if history is a guide, before fees and taxes. What high valuations do not reliably predict: the timing or size of a correction. This is where many analysts get it wrong. A CAPE of 41.4 does not mean the market will crash next month, next year, or even in the next 3 years. It means the expected return over the next decade from this starting point is lower than normal. The market can, and historically has, remained at elevated valuations for extended periods while still rising further. An investor who sold every time the CAPE crossed 30 would have missed most of the market gains of the past 30 years. The specific danger of market timing at elevated valuations: the investor who sells their entire equity portfolio because CAPE is 41.4 faces two specific problems. First, they need to be right about the timing of the correction, which is extraordinarily difficult. Second, they need to decide when to re-enter, which is equally difficult and often results in missing the recovery. Studies consistently show that investors who attempt to time market corrections based on valuation signals underperform buy-and-hold investors over most time horizons, because the timing decision introduces errors in both directions. The specific implication for a Canadian investor holding XEQT holds approximately 45% U.S. equities, giving significant exposure to the elevated S&P 500 valuations. It also holds approximately 25% Canadian equities, approximately 25% international equities, and approximately 5% emerging markets, all of which are at considerably lower valuations than the U.S. market. The TSX is currently trading at a forward PE of approximately 14 to 15, meaningfully below historical average, not above it. International developed markets are similarly attractively priced relative to the U.S. An investor in XEQT is not entirely exposed to U.S. valuation risk. The geographic diversification provides meaningful protection. The valuation picture is clear. The market is elevated on multiple measures. Forward return expectations are lower than the historical average. The adjustments for globalization and structural margin improvement are real, but do not fully explain the premium. What should a Canadian investor actually do with this information? Action 1. Do not change your investment strategy based on CAPE. This is the most important action, which is, in fact, inaction. Attempting to time the market based on valuation signals has consistently underperformed simple buy-and-hold strategies. The CAPE has been above its historical average for most of the past 30 years. An investor who exited equities whenever CAPE exceeded its median would have been out of the market for the majority of one of the greatest wealth creation periods in market history. Action 2. Calibrate your return expectations downward. The honest, evidence-based expectation for a globally diversified equity portfolio over the next 10 years, starting from current valuations, is probably 4% to 7% nominal annually, not 10%. This affects financial planning. The model that assumes 10% returns annually over the next decade should be stress-tested at 5% and 6%. If the plan still works at those numbers, the current valuation environment does not require a change of strategy. Action 3. Maintain geographic diversification. This is where the Canadian investor has a specific advantage. XEQT's approximately 25% allocation to Canadian equities and approximately 25% to international developed markets provides meaningful exposure to markets trading at considerably more attractive valuations than the U.S. The TSX, European equities, and Japanese equities are all significantly less expensive on a forward PE basis than U.S. large-cap stocks. Geographic diversification is not just risk management. It is valuation management. Action 4. Continue contributing on a fixed schedule regardless of headlines. Dollar cost averaging. Investing a fixed amount on a fixed schedule, regardless of market conditions, is the specific mechanical response to uncertainty about market timing. If the market falls significantly from current elevated levels, fixed contributions buy more shares at lower prices. If the market continues higher, contributions compound on a growing base. The schedule removes the timing decision entirely. Action 5. Do not add leverage at these valuations. This is the one specific action a prudent investor might take differently at CAPE 41.4 versus CAPE 16. Borrowing to invest in equities through a margin account, leveraged ETF, or home equity line amplifies both gains and losses. At elevated valuations where the downside risk is meaningfully higher than at average valuations, leverage increases the probability of a forced sale at a market low. Avoid leverage in an elevated valuation environment. Let's come back to where we started. Is the market overvalued right now? The honest answer? By most measures, yes. Significantly. The Shiller CAPE at 41.4 is the second highest reading in market history, exceeded only by the dot-com peak of 44.2 in December 1999. The current CAPE is 77% above its long-term trend line and in the highest historical quintile. The Buffett Indicator at 237% is at an all-time record high. The historical relationship between these readings and subsequent forward returns suggests lower than average returns over the next decade. The adjustments are real and meaningful. The globalization-adjusted Buffett Indicator sits at approximately 112%. Elevated, but not extreme. The forward PE of 21.5 is above average, but pricing in genuine AI-driven earnings growth expectations. Structural changes in corporate profitability argue for a higher fair value CAPE than the historical median of 16.1. But adjustments that justify a higher fair value CAPE, perhaps 22 to 25, do not justify 41.4. The market is elevated. The expected return over the next decade is lower than the historical average. A significant correction is more likely from this starting point than from a CAPE of 20. And none of that tells you when, or how much, or whether the AI productivity wave will justify today's multiples in hindsight. The rational response: stay invested, lower your return expectations, diversify geographically, dollar cost average on schedule, avoid leverage. This is not exciting. It is correct.